All right, this is going to be a video lecture on materials we were going to talk about in person, mainly what I've got labeled as the will handout class. And we're going to go through what a zero tax will looks like. We talked about it a little bit in class, how no matter what size estate you have, when the first person to die passes away, if you have a zero tax will, there can be no estate tax at the first death. And you accomplish that by two things. One is by shifting an amount over to your exemption amount, that $11.7 million number, that has zero tax effect to it because we all have that exemption amount. And the balance, anything over that amount, whether it's $1 or $40 billion, if it qualifies for the marital deduction, the combination of those two things, your exemption and the marital deduction, cause no tax to be due. As you know from last week, the marital deduction piece will come later. The IRS is going to look at that later when that spouse dies subsequently, and that's in his or her estate, whether it was marital outright or marital in trust under what we call the 2056 B5 trust, or a marital, and if it's a B5 trust, you know it's in the spouse's estate because that trust has a general power of appointment in it. If it's a B7 trust, it's in their estate because it got the marital deduction, and there's a separate code section that pushes 2056 B7 marital deduction trust property into the surviving spouse's estate when he or she dies second, and you're analyzing his or her estate. So you can engineer fairly easily zero tax at the first death. Um, and the exemption is a big part of doing that. We all have the exemption. We all have this $11.7 million tax-free amount. And so with our wealthy clients, it becomes a matter of making sure we use it smartly or use it strategically. Dogs are out here with me, so you might see them running around a little bit. We've got people in the house, so this is the quietest place to do this right now. So the structure of the will is how that happens. Um, and I distributed a last will and testament of John Doe that'll kind of walk us through how this works. And if you'll pull that out, pull it up, or somehow get it in front of you so you can reference it as we're going through it. But as a side note, it's just got some basic stuff that should ring a bell from your wills, trusts, and estates class. The introduction says that John Doe is of sound and disposing mind and memory, publishes this will as his last will and testament, and hereby revokes all other previous wills. That's all important so that we know that this is the will going forward. The next item, Roman numeral 1, introduction, that's not mandated by any will statute. We just do that so that everybody knows who the players are. John is married to Jane. They have two kids, Bobby and Susie. As we use the word children throughout the will, that's who we mean, Bobby and Susie. This one does not have an afterborn clause in it. If it did, the next sentence would say, children shall also mean any children born to or adopted by me after the date of this will. And so that's just a little bit of helpful language to the reader someday. Item Roman numeral 2, we're going to pay our debts. Item Roman numeral 3, we usually segregate disposition of personal property, books, clothing, furniture, jewelry, things like that, from what I call the real stuff, the cash, the real estate, the stocks, the bonds. That's all going to come later. But normally, it doesn't make sense to put furniture and cars and jewelry, sometimes jewelry, furs, things like that in a trust. Normally, it makes sense just to get that outright to somebody. So we normally handle personal effects in their own little section. Paragraph A of that section is what's called the non-binding memorandum. If you want to make a non-binding list of what you want to happen with the personal property, you can. It is my hope that my daughter gets my wedding ring. It is my hope and my intent that my son gets my gun collection. Paragraph, but that's all it is. It's non-binding. It's up to the executor to carry that out. Paragraph B is the binding stuff. All of those things go to my wife, Jane Doe. If she's not living, give it to Bobby and Susie. You can also do a paragraph A that is binding. All right. So all those are little side notes that more relate to wills, trusts, and estates than it does to the estate planning class, nonetheless. Item Roman numeral 4 is kind of the engine of a tax planning will, where we are trying to maximize the use of the exemption and the marital deduction to avoid tax at the first death, no matter how big the estate. And if you go through that Roman numeral 4 and start to read it, it says, if my wife Jane survives me, so we have a contingency. None of this is going to apply if Jane doesn't survive. We don't need a marital deduction if Jane doesn't survive. But if my wife survives me, I give to my trustee. I'm not giving to Jane, I'm giving to my trustee. So that should tell us that we're going to have a marital in trust type structure, a B5 or a B7 type trust. I give to my trustee as hereinafter named, because later on in the will we name who the trustee is, for my wife's benefit in trust for the use, ignore the word however there, for the uses and powers hereinafter set forth. This is what we're giving the trustee. This is a little complex and a little confusing. You're gonna have to read it a few times. It's not straightforward, just English. But here's what I'm giving. I'm giving an amount equal to the maximum marital deduction in determining federal estate tax payable at my death. So I'm giving maximum marital deduction, um, which, if you think about it, is everything. I'm giving the maximum marital deduction. That's as far as we've gone so far, which means I'm giving everything to my wife. If it's a 21.7 million dollar estate, then I'm giving $21.7 million, the maximum marital deduction, to the trustee for my wife. However, the next word is reduced. I'm giving that amount reduced by the value for federal estate tax purposes of, ignore that part. Go all the way down, reduced by that amount, if any, needed to increase my taxable estate to the largest amount, which, after taking into account the credit under IRC section 2010. So we start with the maximum marital, which is really everything, and we're going to reduce it by that amount needed to increase my estate to the largest amount, which, taking into account the credit under 2010, IRC 2010, which is the exemption amount, taking into account that exemption amount, that's available to my estate. Available to my estate is kind of important, because we've learned you can use that exemption amount during life or at death. So if you used it during life, it's not available to your estate because you've already used it. If you've used some of it during life, then not all of it's available to your estate, but some of it's available to your estate. So you take the maximum marital, reduce it by that amount needed to increase my taxable estate to the largest amount, which, after taking into account the credit under IRC 2010 for federal estate tax purposes, few other words, that will result in the least possible federal estate tax being paid at my death. So what that really means is, take the maximum marital amount, which is really everything, because you can leave everything to a spouse and get the marital deduction. Reduce that maximum marital amount by the amount that's needed to make my estate the biggest that it can be without paying estate tax. What's the biggest an estate can be without paying estate tax right now in 2021? That amount is 11.7 million. So take the maximum marital, everything that I could leave to a spouse and get the marital deduction, which in my case, we said it's a $21.7 million estate. That's 21.7 million. I can leave to my spouse. That's a maximum marital. Reduce that 21.7 by the largest amount that can create the biggest taxable estate that avoids estate tax. And we know this year that the biggest taxable estate you can have and not pay estate tax is 11.7 million. So what it's really saying is, take the maximum marital amount and reduce it by 11.7 million, which takes us down to 10 million. 21.7 minus 11.7 is 10. So you got to do some math in the marital devise. Start with the maximum amount of marital assets, could be everything going to your spouse. Reduce it by the biggest estate I can have and not pay estate tax, which is 11.7. And the result of that is $10 million. That is your marital amount. That's your marital devise in this will. So what you're left with is 10 million is going to be disposed of pursuant to item Roman numeral 4. And if you read the rest of Roman numeral 4, it'll say, once you figure out that number, that 10 million, it's going to say, hold that amount in accordance with the terms and provisions of the item known as Trust Estate A, which is really going to be item Roman numeral 6. So kind of hold that for a second. Figure out your math, maximum marital less biggest estate I can have without paying tax. In this case, 21.7 in my example, biggest your whole estate, minus 11.7 million, that's the biggest estate I can have and not pay tax, equals 10 million. 10 million is the amount that item Roman numeral 4 calculates. And then item Roman numeral 4 says, hold that amount in accordance with the terms and provisions of the item called Trust Estate A, which in this will happens to be item Roman numeral 6. And then we'll come back and see what Trust Estate A says later. So of our $21.7 million fictional estate, we've carved out 10 as our marital amount. Go back and listen to this a couple times if you need to or want to figure out how we got to that number 10 million, because that's pretty important. Then you go to item Roman numeral 5, and it says residue. I give into my trustee hereinafter named, because we haven't really identified who the trustee is yet, for the uses and purposes and terms and conditions, powers and duties, all the residue of my estate. Started with an estate of 21.7 million. We carved off 10 in item Roman numeral 4. So the residue is 11.7. That's not by accident. Our residue happens to be the tax-free amount, 11.7. Hold that residue in accordance with what's called Trust Estate B. And Trust Estate B just happens to be item Roman numeral 7. So now we've got two trusts. We've got a Trust A that has been delivered $10 million, and we've got a Trust B that has been delivered the residue, which is everything left in the estate, which is 11.7 million. Those two things together equal 21.7 million, which is the whole value of our estate. If we had used 1 million of our tax-free amount during life, then when we did the calculation in item Roman numeral 4, which starts with a maximum marital amount, which is really everything, because everything can go to the spouse and get the marital deduction. We start with a maximum marital amount, 21.7, less the biggest estate we can have and avoid estate tax. If we've used 1 million of our exemption, what's the biggest estate we can have and avoid estate tax? Not 11.7, but 10.7. So in that scenario, item Roman numeral 4 would have come up with an amount of 11.7 minus 10, 21.7 minus 10.7, which would have given you an answer of $11 million. So 11 million would have been governed by item Roman numeral 4 and directed to Trust A. The residue of the estate would have been 10.7 million. 21.7 minus 11 gives you 10.7, and which just happens to be our remaining exemption amount, because in my example I said we used 1 million of it. So we have 10.7 left. That's governed by the residue paragraph in item Roman numeral 5, and that's directed to Trust B. And we can walk through this again at the beginning of the class next week, but you kind of need to understand that a tax planning will is going to calculate those two amounts. It's going to calculate the marital deduction piece, and it's going to calculate the tax exempt piece. This will kind of backs into the tax exempt piece. it calculates the marital first, and then you're left with the residue, which if you do it right, should give you the decedent's remaining tax-free amount. And it directs the tax-free amount to B, the marital deduction amount to trust A. Nothing, nothing unique or statutory about those names. That's just in the industry. People tend to call the marital trust Trust A, and they tend to call the tax-exempt trust Trust B. Some people call the tax-exempt trust the credit shelter trust. Some people call the marital trust the marital trust. People call the tax-exempt trust the family trust. Our documents just call the tax-free amount one the B and the marital one the A. Now, what I'd like to do is go to Trust A and take a look at Trust A, item Roman numeral 6. Trust A is designed, so what we've got at this point is we've got kind of a will that does this. We have an estate that got divided into 2 shares by the terms of that will. And it sent the marital deduction amount here, what we called Trust A, which I'll draw in a second. And it sent the tax exempt amount, the residue, to Trust B. So we've got a 2 shares estate. Interestingly, this marital amount, this item Roman numeral 4, when it defines, is it 4? Yes. When it defines the marital amount, it could have sent that amount outright to the spouse. Your choices are, so far we've talked about 3. It could have gone outright. You still would have defined it the same way. Maximum marital amount, which is essentially all the estate, less the biggest estate I can have and not pay estate tax, because I'm going to carve that over here. And then the difference, what I'm left with, is going to be the marital amount. That can go outright to the spouse, or it can go in trust. And we've learned 2 types of trusts it can go in, a B5 and a B7. And those are primarily those are the only 2 we're going to talk about in this class, the B5 and the B7. This will happens to direct it to a trust. If it was outright, item Roman numeral 6, instead of saying Trust A, would have said something like, the amount directed to this item shall be distributed outright to the surviving spouse. But this one sets up a trust for the surviving spouse. So we end up with 2 trusts, a B trust and an A trust. Now the A trust, if you look at item Roman numeral 4, let's kind of talk about what it says. It's for, the first couple lines of it are, for my wife during her lifetime. Good. So we know it's going to be for life, and we know a marital trust has to be for life. We know it cannot be a terminable interest. It can't be for my wife for 10 years, or for my wife until she remarries, or for my wife so long as she does what I say she does. It's got to be for life. So that kind of goes back to the definition of terminable and non-terminable interest. So it's going to be for life. And now we got to say, what does it do? What's it do during her life? During the lifetime of my wife, the trustee shall, that's not may, that's shall, and that's intentional. The trustee must do this, shall pay to her all of the income from Trust A in such installments as may be convenient, but no less frequently than annually. So we learned last week, both in a B5 and a B7 trust, the spouse has to get the income on an annual basis. Must. That's kind of one of the most important things you can have in a marital trust. And that's why this says you shall do this. And I don't care if you do it monthly or weekly or installments that are convenient to my wife, but in no event less frequently than annually. So every year that income has to come out. Now, we could have stopped there because we know that that's all B5 and B7 require. They require income must come out, but they allow for more. They allow, if the client says, I want my wife to have more than the income, I want her to have access to principal. And in this example that's the case. In addition to all the income, I direct that the trustee may appoint to my wife from the corpus of Trust A such amount as from time to time may be necessary to maintain her in health and reasonable comfort, to support her in her accustomed manner of living, to provide for health, medical, dental, hospital, nursing expenses, expenses of invalidism, um, taking into account other resources. So stopping right there, you should start to have a clue what kind of trust this is, whether it's a B5 or a B7. Um, Principal can be appointed to the wife. So it tells you, hey, we might have a general power of appointment. But we also learned, which would be a B5 trust. But we learned when we studied 2041 that when you have a power of appointment that makes distributions to the power holder, although that can be and is a sign of a general power of appointment, we get out of general power of appointment world if the spouse can only appoint to himself or herself for things like health, education, maintenance, standard of living, and that's what these words are. And in fact, the next sentence clarifies that. It's my intention that this power, which has been granted to the trustee in the immediately preceding sentence, shall be limited by an ascertainable just standard as defined in the Treasury regulations, and it gives a site for where those are. And furthermore, such power shall not be a general power of appointment. So we are making it clear to the reader and the IRS, they may be a reader someday, that although my wife can have access to principal herself, and that appears to be a general power of appointment because a GPA is if the the beneficiary's estate, the beneficiary's creditors, or the creditors of the beneficiary's estate can have access to principal, that's a GPA. But we also know later in the statute it says, hey, but if you can only get it for ascertainable standard, it's not a GPA. We're making it clear that that's what's happening here. Spouse is getting income for life, which they have to get, and they're also getting optional access to principal for HEMS, health, education, well, I don't think education's in here, health, maintenance, and support. And as long as it's HEMS, ascertainable standard, it's not a GPA. That doesn't mean that the assets are not included in the wife's estate when she dies second. It just means they're not included under the GPA inclusion statute, 2041. If this is not a GPA, it's not a 2056B5 trust, what does that leave? It really leaves a 2056B7 trust, which is the qualified terminable interest property. And if we go back and look at 2056B7, which you should, pull that out next to this will, and you'll kind of see it checks all the boxes. Spouse has to get income annually from the assets. Nobody but the spouse can have any power of appointment during the life of the spouse. Nobody here does have a power. The only person that can get principal is the spouse. And one of the requirements is an election, which is made on the estate tax return of the wife when she dies second. That's not going to be in here. So if you were to track the 2056B7 statute next to this trust, it would show that this meets all the requirements of a 2056B7 trust, which is qualified terminable interest property, QTIP. Sometimes these trusts are called QTIP trusts. A is a QTIP, qualified terminable interest property. So A is going to be our marital deduction trust. It's in trust for life. She must get income. She can have more for ascertainable standard type purposes with the trustee involved. And then the rest of item Roman numeral 6 goes on to say, if you kind of skip forward a little bit, goes on to say there is I think a B2 paragraph that says, after my wife is dead, what do I do with it? I'm going to pay the leftovers over to my kids in accordance with what B says. I'm going to get it over to it doesn't have to be to my kids, but this one just happens to say, hey, when my wife is dead, send the leftovers over to B, administer it that way. I want to go to B. Back in the beginning of the will, the residue sent the residue, which was engineered to be the tax-free amount. Marital deduction less biggest tax-free amount equal the marital amount. What does that leave? It leaves the tax-free amount. That goes over to B. So B is an amount that was not taxed when husband died, when John Doe died. And in a perfect world, it won't be taxed when wife dies. We want it put in a trust in a way that's available to wife, can be used by wife, can even be controlled by her as the trustee, but doesn't put it in her estate when she dies second. So let's look at the language of Trust B and see what it does. It starts out, the trust is for my wife for her lifetime. Doesn't have to be, because remember, this one can be a terminable interest because it's not marital deduction property. But this one just happens to be for my wife for life because this guy wanted to provide for his wife for life. During the lifetime of my wife, the trustee shall pay over the income in Trust B to my wife at least annually. He doesn't have to because Trust B is not governed by 2056 B5 or B7. He just wanted to give income to wife for her lifetime. Trust B could have easily said during the second sentence, during the lifetime of my wife, the trustee may pay income to my wife if she needs it. Um, you have a lot more flexibility because you don't have to meet the rigid marital deduction rules. But this one just happens to say, hey, she gets all the income, just give it to her annually. He wants her to have more than income. Furthermore, the trustee may appoint to my wife from the corpus of Trust B such amount as may be necessary for health and reasonable comfort, a custom manner of living, healthcare, medical, dental, hospital, nursing expenses. So it reads just like A. Um, what's important here in B is we want to make sure we structure B in a way to provide benefits to wife, but doesn't push it into her estate when she dies second. And as long as the access we give her is not a GPA, not a general power of appointment, it's a limited power of appointment, then we haven't pushed it into her estate. Because when we analyze her estate second, she has her own stuff. She has her own stock portfolio, her own cars, her own real estate. All those things are picked up by 2033 when she dies second. When we analyze this trust to see if it's in her estate, 2036 and 2038 are going to say no because she never put stuff in here. He did. She never made a transfer here. So 2036 and 2038 won't